We're also keeping an eye on gold continuing to trade to the downside. The 1,200 mark not too far off from here. The question is whether and if gold will bounce back. Jim Rickards is Senior Managing Director at Tangent Capital. He's our bull. Tom McClellan, editor of the McClellan Market Report newsletter, who joins us on the CNBC Newsline. Thank you both. Jim, let's start with you because I'd like to hear the case, I guess, for buying gold at these levels.
Well, it all depends on Fed policy. The reason gold has been going down lately is because the Fed has been tightening. You have basically real interest rates have gone from about 70 basis points negative to 50 basis points positive. That's a 120 basis point increase in real rates. Gold likes negative real rates. In other words, when inflation is higher than the nominal rate. What's happened lately is inflation has gone down, nominal rates have gone up, real rates have gone steeply positive, and so that's bad for gold. So if you say if the Fed continues the tight policy, then gold will continue to trade down.
But wait a minute, Jim, what's the case for buying? Because you're bullish gold right here. So what's the case for buying gold right now?
The case for buying gold is that the Fed's going to back off. They're not going to taper. Later this year, they'll actually increase purchases because deflation is winning the tug of war between deflation and inflation. Deflation is the Fed's worst nightmare. So in the next 2 months, the Fed will make it clear they're not going to taper. They'll increase purchases later this year. They'll try to get negative real rates, and that's very bullish for gold.
Tom, we know you like to put charts on charts, look at price patterns. You've actually, at the request of one of your readers, tried to do this between gold and what stocks did in the '09 lows. What does it tell you?
Well, it's a fascinating comparison. What we see in any charts is the personality of the people trading whatever is being looked at. And what we're seeing in gold is the same pattern of the decline and just in the last 2 years that we saw in the stock market from 2007 to 2009. It's the same emotional play that's going on. People falling out of love with stocks back then, people falling out of love with gold now, and we're reaching the climax point equivalent to the March 2009 low for the stock market.
That chart that we just showed, Tom, suggests that Jim might actually be right, at least in the near term.
There are lots of reasons to be in love with gold right now. The biggest one is that everybody else seems to be falling out of love, and nobody seems to like it. The commercial traders, if you look at the Commitment of Traders data, the commercial traders are at their most bullish stance since the 2001 low, and they usually get proven right. It may take a week or two before that starts to matter, but it's a really hugely bullish condition for gold, and I'm expecting a really large rebound.
That may be the case, but how do we know when we've put in the lows? Because obviously everyone would have loved to buy in the right time in March 2009. How do they know when is the right time to buy here?
Well, the right time to buy is when the Fed starts easing up. Right now, they're tightening monetary policy. That's the most important thing. They can't do that. Deflation is their worst nightmare. They've got to loosen up. Look, I own gold. I buy gold. I recommend it for clients. Not more than 20% of your investable assets. The destination for gold is $7,000 an ounce, but the Fed continues to tighten. It could trade down to 1,000 on its way to 7,000. That's important for investors to know.
7,000. Tom, you want to comment on that?
I can't target that high. I got upside targets of between 2,800 and 4,400 based on some technical studies. But we could get to 7,000 maybe later. But the biggest reason, the thing that we haven't had yet, we haven't had that Orange County, California blow-up moment like we had in the 1994 bear market in gold. Orange County, California went bankrupt, and that marked a low for bond prices. The moment that we see a big major gold producer announcing that it's curtailing production or it's going out of business, that'll be the moment that we mark the low in gold, and I expect to have one of those announcements any minute.
Well, in some ways, if it's a gold producer, that's more favorable than if it's someone on Wall Street, say?
Yep.
Well, we're getting down to the production level, to the production price of gold right now, and they won't continue producing gold unprofitably for very long.
That's a good fundamental analysis. I also look at it geopolitically. Sometime in the next year, China will announce that they've actually acquired over 4,000 tons of gold. That will be a catalyst also. People say, why is China buying gold if it's so worthless?
Jim, today, USA Today reminds people that in the early 80s, gold lost 65% of its value, even though this quarter we're looking at 20-some-odd%. You think that a decline of that magnitude is impossible?
No, well, not at all, but there were good reasons for it then, Carl. The reason was when gold was $800 an ounce, all the gold in Fort Knox and West Point at the market was more than 100% of M1. That's ridiculous. That was truly a bubble. Today, that number is about 17%. So they're not at all comparable. It should have gone down in the 80s because, by the way, you had positive real rates. That's what Volcker engineered. He got interest rates above inflation. You had positive real rates. Horrible environment for gold. Today, we're seeing a little bit of that with positive real rates, but the Fed's going to flip it, get negative real rates, and that'll be a catalyst for gold.
Well, we've certainly gotten some comments from Jerome Powell of the Fed in the last couple of minutes suggesting they will act if inflation falls below their target. Jim and Tom, thank you both.
Thank you.